Today we're going to talk about how Social Security benefits are taxed and what that means for your overall income plan in retirement. A lot of people assume Social Security is tax-free, but it can be partially taxable depending on your total income. What makes this important is the way your other income sources are structured, like IRA withdrawals, pensions, or investment income, which can directly impact how much of your Social Security ends up being taxed. As we go through this, the goal is to simplify how the rules work and show how thoughtful planning can help reduce the tax impact over time. By the end, you'll have a clear understanding of how Social Security fits into your broader tax and income strategy. I'm Rick Pinarija, 30 plus years helping families with retirement income, estate planning, and risk. Today is about how annuities fit into a real plan. I'm founder of American Benefit Resources. For 30 years, I've sat at kitchen tables with families working through the same two worries. Will my income last? And will my family be okay? That's why we built Velocity Principal for retirement income and Living Trust 360 for estate protection. Together, they're what we call ABR 360. Always be ready. Every angle covered. Because peace of mind isn't luck. It's preparation. And that's what today is about. One of the biggest misconceptions is that Social Security is always tax-free, but that's not the case. Your benefits may be partially taxable depending on your overall income. As income increases, a larger portion of your Social Security can be included in your tax calculation. At the highest levels, up to 85% of your benefits may be subject to taxation, but again, that doesn't mean an 85% tax rate, just that portion is counted as income. And it's important to note that not all retirees pay taxes on their Social Security. If income stays below certain thresholds, benefits can remain completely tax-free. It really comes down to how Social Security interacts with your other income sources. What determines whether your Social Security is taxed? It all comes down to something called provisional income. This is the formula the IRS uses to decide how much of your benefits become taxable. What's important here is that it combines multiple income sources, things like IRA withdrawals, pensions, wages, and even tax-free interest. So it's not just your Social Security by itself, it's how it interacts with everything else. That combined number ultimately determines how much, if any, of your Social Security benefits are included in your taxable income. Provisional income is the key formula that determines how Social Security is taxed. It starts with your adjusted gross income, which includes things like wages, IRA or 401k withdrawals, and pension income. Then we add back any tax-exempt interest, such as income from municipal bonds, even though it's normally not taxed. It still counts in this calculation. Finally, we include half of your Social Security benefits. Not the full amount, just 50%. When you add those three pieces together, you get your provisional income, and that number determines how much of your Social Security becomes taxable. So again, it's not just about the benefit itself, it's how all your income sources work together. Now let's look at the income thresholds that determine how Social Security is taxed for a single filer. If provisional income is below $25,000, none of the Social Security benefits are taxable. Once income moves between $25,000 and $34,000, up to 50% of the benefits may become taxable. And once income exceeds $34,000, up to 85% of the benefits may be included in taxable income. One important thing to keep in mind is that these thresholds are not indexed for inflation, which means over time, more people may find themselves paying taxes on their benefits. So even modest increases in income can gradually push more of Social Security into the taxable range. Now let's look at the thresholds for married couples filing jointly. If provisional income is below $32,000, none of the Social Security benefits are taxable. Between $32,000 and $44,000, up to 50% of the benefits may be taxable. And once income exceeds $44,000, up to 85% of the benefits may be included in taxable income. Just like with single filers, these thresholds are not indexed for inflation, so over time, more couples can find themselves crossing into higher taxation ranges. This is why coordinated income planning becomes especially important for married households. This is one of the most important clarifications to understand. When we say up to 85% of Social Security is taxable, that does not mean you're paying an 85% tax rate on your benefits. It simply means that up to 85% of your Social Security is included as part of your taxable income. From there, it's taxed at your normal income tax rate, whatever bracket you fall into. The impact depends on your overall income, not just the Social Security itself. This is a key distinction, and understanding it helps avoid a lot of confusion when planning. So why does Social Security taxation really matter? First, it can increase your total taxable income. As more of your benefits become taxable, it adds to the income the IRS is calculating taxes on. Second, it may push you into a higher tax bracket. Even a small increase in income can cause a larger portion of your income to be taxed at higher rates. And finally, it plays a big role in retirement income planning. How and when you take income from different sources can directly impact how much of your Social Security is taxed. That's why coordinating withdrawals and income sources is so important. It can help reduce taxes and improve overall efficiency in retirement. The good news is that Social Security taxation isn't just something we react to. It's something we can plan around. One strategy is managing IRA withdrawals. Since those withdrawals count toward your income, controlling how much you take and when can help limit how much of your Social Security benefit becomes taxable. Another approach is considering Roth strategies. Because Roth distributions are generally tax-free, they don't increase provisional income in the same way, which can help reduce taxation on Social Security. And finally, timing matters. Coordinating when different income sources are used, like pensions, investments, or withdrawals, can make a meaningful difference in overall tax efficiency. The key is being proactive and intentional with how income is structured throughout retirement. To wrap this up, there are a few key takeaways to remember. First, Social Security taxation is driven by your total income, not the benefit itself. It's how everything works together that determines the outcome. Second, more income generally means more taxation. As income increases, a larger portion of your Social Security can become taxable. The good news is that planning can help reduce that impact. By being intentional with withdrawals and income sources, we can often improve tax efficiency. And finally, coordination is key. The way different pieces of your income plan fit together can make a significant difference over time. The goal isn't just to generate income in retirement, it's to do it in the most tax-efficient way possible. I think we'd all admit that circumstances change, and sometimes rather quickly. In other words, life happens, and none of us really know how things will turn out. My offer to you here today is this: to sit down, talk, and decide if we are a fit to work together. If we decide to move forward, I will be available to you whenever questions arise or adjustments have to be made to help keep your plan on track.